Imagine being in front of one of the brightest minds in the world of investments, listening to his reflections on the stock market, the economy, and how he built an empire with Berkshire Hathaway. This is the kind of opportunity that few can say they've had, and for many, Warren Buffett's words are more valuable than any financial advice. However, what makes this interview so iconic is not just what he has accomplished, but how he shares his failures, challenges, and lessons learned throughout his journey. Buffett's journey is one of resilience and wisdom, but it's also marked by moments of doubt and tough decisions. If you've ever wondered how someone can turn a small amount of money into billions, or what the secret behind his successful acquisitions is, this interview offers fascinating answers. In addition to sharing his investment philosophies, Buffett reveals the behind-the-scenes decisions that made Berkshire Hathaway one of the biggest success stories in business. In this content, you'll discover the keys to his strategic thinking, how he views the future of the economy, and his vision for Berkshire's legacy. Get ready for an immersive dive into the mind of one of the greatest investors of all time, who teaches with humility and intelligence the importance of understanding the true value of a business and how investing is a marathon, not a sprint. Warren Buffett, now one of the most renowned investors in the world, didn't start his journey with a grand plan or a clear idea of what the future held for him. In fact, when he returned from New York in 1956, after studying and working with Ben Graham, his goal was quite simple: to live off the returns from an initial investment of $150,000. He believed that with a 10 return per year, he could lead a comfortable life. What he didn't know, however, was that this would be just the beginning of a career that would forever change his view on the stock market and investing. Buffett's first big step came when he was approached by 7 members of a family who invited him to manage their investments. The offer seemed small, but soon he gathered the capital and formed a partnership that would slowly become the starting point for something much bigger. Without big expectations, young Buffett didn't realize he was taking the first steps toward creating one of the most powerful companies in the market, Berkshire Hathaway. What he actually wanted was just to grow and learn in the process, without rushing to reach a final destination. Over time, opportunities began to appear, and he found himself making decisions that would shape his investment philosophy. One of those decisions involved buying shares in seemingly undervalued companies, like Berkshire Hathaway, which wasn't considered a good business at the time. But, as Buffett has always emphasized, his focus wasn't on the stock price, but on the long-term value he believed these companies could offer. What started as a simple resource management job would turn into an empire based on careful analysis of businesses, industries, and, most importantly, a strategic vision for growth. When Warren Buffett decided to venture into the insurance industry, he already had a pretty clear vision of what he was looking for in a business: control over the cash flow. Entering the insurance market was a strategic move. Buffett realized that this sector not only offered a way to generate funds for investments, but also had a model that would allow him to make decisions based on a more precise risk analysis. From that point forward, the insurance market would become a key pillar in Berkshire Hathaway's growth, providing the financial resources needed for acquisitions and creating a diverse portfolio. The acquisition of National Indemnity in 1967 was a turning point in this process. By buying the company for $84 million, Buffett opened the door to a new growth cycle. The insurance industry wasn't something completely unknown to him. On the contrary, Buffett understood the math behind it, the interest rates, premiums, claims, and how to use this knowledge to his advantage. What he saw in the insurance market was an opportunity to leverage capital smartly, allowing him to invest in companies and assets even more effectively. This transition to the insurance sector wasn't just about money, but about an investment philosophy that involved controlling capital. For Buffett, insurance was an almost unlimited source of resources to be invested. He knew that proper management of insurance companies' capital, with a rigorous risk analysis and a solid investment strategy, could result in substantial returns. The insurance industry's business model, combined with his long-term investment philosophy, provided Buffett with the necessary foundation to expand his acquisitions and achieve consistent and secure growth far beyond what he initially imagined. When Warren Buffett bought Berkshire Hathaway, he wasn't acquiring a rare gem, but rather a struggling company, with a textile sector that had little future prospects. At the time, Berkshire was a declining textile company, and Buffett's decision to enter that market seemed a bit risky. But for him, the purchase wasn't just a financial transaction, it was an opportunity to apply his investment philosophy. He believed that, even with an unstable foundation, the company could be transformed, as long as the right choices were made in terms of capital allocation and acquiring new businesses. Buffett, as he always has throughout his career, used his business analysis skills to evaluate Berkshire. Although the textile industry was in a tough spot, he saw the value in the company, especially due to its business model and the potential for strategic changes. What he didn't know was that this acquisition, which initially seemed like a distraction, would become the vehicle that allowed his investment philosophy to grow even stronger. Berkshire Hathaway would transform from a textile company into an investment holding company, buying stocks and businesses that aligned with Buffett's vision of a long-lasting company with strong growth potential. Over the years, Buffett recognized that the textile industry wasn't ideal for Berkshire Hathaway's growth, and he admits that staying involved with it for so long was a mistake. However, the experience with Berkshire became a crucial learning process about the errors and successes along the way. More than that, the transformation of Berkshire Hathaway reflects Buffett's resilient spirit, someone who not only adjusts his strategy based on circumstances, but also learns from mistakes and adapts. The company's journey, initially marked by challenges, would become the foundation for one of the most impressive success stories in the stock market. The acquisitions Buffett made over the years are a clear reflection of his investment philosophy. He always looked for companies with intrinsic value that were trading for less than they were worth. One of the most notable acquisitions was the purchase of Geico, an auto insurance company. In the beginning, many investors doubted this move, as the insurance market didn't seem too attractive at the time. However, Buffett saw the potential for growth, knew that Geico had a unique value proposition, and, as he always does, believed he could maximize that potential in the long run. What seemed like a risky decision became one of the greatest successes of Berkshire Hathaway. In addition to Geico, another iconic investment Buffett made was buying Coca-Cola shares. The company was facing difficulties during a time of great market volatility, but Buffett knew that the brand's value, consumer loyalty, and the strength of its business model would make it a great opportunity in the long run. He bought Coca-Cola shares during a market downturn, and this investment turned out to be one of the most profitable bets of his career. For Buffett, the key to success wasn't predicting short-term market moves, but identifying solid companies with sustainable growth potential. The acquisition of companies like Nebraska Furniture Mart also perfectly fits into this philosophy. Even without a major international name, the founder's story, who came from humble beginnings to build a furniture empire, caught Buffett's attention. He saw in her the same mindset that he believed was essential for success: resilience, strategic vision, and a tremendous dedication to the business. These acquisitions and investments weren't just based on financial analysis, but also on observing the character of the companies and the people behind them, something that became a central principle in his investment strategy over the years. Warren Buffett has always had a unique view of what it means to invest wisely. For him, the key to success lies in deeply understanding the business you're investing in. Unlike many investors who focus only on market fluctuations, Buffett believes a good investment is one that you can fully comprehend. He avoids the complex teachings and the uncertain, preferring to invest in companies that operate in simple sectors with easy-to-understand business models. This approach, which might seem conservative to some, is what allows him to have confidence in his decisions, even when the market is turbulent. Additionally, a core part of his investment philosophy is rigorous company analysis. Buffett believes it's necessary to deeply understand the company's management, its financial health, and growth prospects before deciding to invest. He never relies solely on superficial analysis or third-party recommendations. Each investment is the result of meticulous analysis, where he evaluates the company's fundamentals and long-term potential. What sets Buffett apart is his patience and his focus on the real value of companies, rather than being concerned with speculative market movements. Another central point in his vision is management. For Buffett, one of a company's greatest assets is the quality of its leadership. He has always sought trustworthy managers who share his values and are capable of making intelligent decisions for the company's future. Instead of trying to control the companies he invests in, he prefers to trust the leaders of those companies, knowing that good management will be the differentiator for success. This trust in management also reflects his long-term approach, where the goal is to let businesses grow and develop over time, rather than seeking quick and immediate profits. Although Warren Buffett is widely recognized for his success in the investment world, his journey has also been marked by challenges. One of the biggest obstacles he faced was the temptation to stray from his conservative investment philosophy. When the market was booming in the 90s, for example, many investors were making a lot of money through speculation. Meanwhile, Buffett stayed true to his approach, which prioritizes the intrinsic value of businesses, and this sometimes made him feel temporarily disconnected from the major market movements. For him, this was a phase of letting the market do what it wanted, while he continued to invest calmly with a long-term focus. What sets Buffett apart from most investors is his patience. Instead of trying to make quick money, he focuses on the consistent and sustainable growth of businesses. His investment philosophy is based on detailed analysis, which involves not only financial figures, but also the company's culture and the quality of its management. For Buffett, the greatest risk isn't losing money on a single investment, but not fully understanding where you're putting your money. That's why he only invests in companies that he fully understands and believes in their long-term future. One of the biggest lessons Buffett has learned over the years is that, as unpredictable as the stock market may be, high-quality companies always find ways to adjust and thrive. This is the true value of sticking to his investment philosophy. That's why he never rushes to sell an asset just because the market is volatile. For him, the best strategy is to look beyond the turbulence and invest in what is solid and promising in the long term. When you have a clear vision and careful analysis, market challenges become just opportunities to learn and adjust the course. Warren Buffett has a very pragmatic view when it comes to the global economy and the United States. For him, it's impossible to predict the future with precision. But one thing is certain, there will always be ups and downs, and the key is to have a rational approach to uncertainty. He notes that, while the stock market and the economy go through periods of volatility, the vast majority of successful companies and investors know how to handle these cycles of growth and recession. Buffett's perspective on the U.S. economy, especially regarding the trade deficit and inflation, is that, while the challenges are real, they're not insurmountable. The important thing to him is to understand how the economy works and how the government deals with these issues over time. One of Buffett's most evident concerns is the U.S. trade deficit. He believes the country, by consuming more than it produces, is selling pieces of the farm to the world, trading valuable assets for goods and services. This exchange of assets especially through debt issuance, has implications for the future economy. In the long run, this dependence on external resources can create risks, such as the devaluation of the dollar and loss of competitiveness. However, Buffett also acknowledges that due to the strength of the American economy and its immense capacity for innovation and production, the country has enough resources to sustain these imbalances for a long time. But like any great investor, Buffett is also concerned with inflation and government fiscal policies. He notes that inflation never fully disappears, it's always lurking, ready to be reactivated depending on political and economic decisions. The key, then, is to manage the economy intelligently, being able to contain inflation without stifling growth. Buffett suggests that investors should always be prepared for inflation cycles and, at the same time, invest in assets that can protect the value of their money against these effects. For him, sound money management and a deep understanding of economic issues are essential to successfully navigate this uncertain landscape. When Warren Buffett thinks about the future of Berkshire Hathaway, he knows that one of the biggest challenges will be succession. The enormous responsibility of managing a company of such magnitude requires careful planning, and Buffett has always emphasized the importance of ensuring that the company's leadership remains aligned with the values and philosophy he built over the years. Has not just concerned with who will take the reins, but with maintaining the management standards and long-term vision that have transformed Berkshire into one of the largest conglomerates in the world. And, of course, he's made sure that the transition will be as smooth as possible, with several candidates being prepared to take over. Buffett also acknowledges that, as the company grows, it becomes harder to find investments that follow the same success model he achieved in the past. Berkshire, with its vast capital reserves, now faces a size problem, meaning that finding companies that offer the same return on investment as Buffett's early deals is more challenging. However, this difficulty doesn't discourage him. He knows that patience is key and that the right opportunities will appear, even if they show up less frequently. For him, the secret is to remain calm, focus clearly on what's important, and above all, not rush into acquisitions without being certain that they're really good deals. Finally, Buffett maintains the philosophy that Berkshire Hathaway should be built to last, not just to generate immediate profits. He's confident that the company will continue to thrive even after his departure, because the management culture he created is resilient and focused on solid investment principles. For him, the future of Berkshire is much more than financial numbers. It's about preserving the business model and the values that allowed the company to become a symbol of success in the world of investments. And in the end, his vision for the company is clear. Berkshire Hathaway will be a company built to stand the test of time and continue to grow, regardless of who leads it.